Right now, everyone's wondering who to blame for the crypto crash. Was it the North Korean hackers? Was it the evil market makers? Was it Javier Milei and his Libra scam coin? Or maybe it's Trump? Well, I've been doing a lot of digging into it, and it turns out it's none of them. Well, at least not entirely. I'm sad to say, it's the same people who we would hope would send our bags to Valhalla, the ones that we dreamed would take us to the promised land. The largest buyers of Bitcoin just flipped to the largest sellers. So who am I talking about, and why are they selling? And most importantly, what should we be doing right now? Well, the answer to the last question might surprise you. I'll be covering all of that and more in today's show. So make sure you guys stay to the end, because this key signal just flashed. And every time this has happened before, the next move has been explosive. So if that sounds good to you guys, what's up? My name is Chasse. Do me a favor, destroy the like button, subscribe to the channel if you're not already. Let's get into it. Currently, price of Bitcoin, early morning my time, bouncing off 82,162, brutal price down. And we've seen a current pullback of 25% from all-time highs. As Miles says over here, Bitcoin ETFs just had another massive day of outflows totaling 755 million. The last 2 days saw a combined outflow of 1.9 billion and set back-to-back records for the second and third largest days in ETF Bitcoin history. Where are we at, guys? Right now, we are in extreme fear. Now, we're going to get into, after we talk about who's responsible for the sell-off and why it's happening, we're going to jump back to this later in this show. This is an important signal to pay attention to, and I'll show you how to use it to your advantage. And if you want to know who also has been panic selling, well, we got record amounts of weak hands that just got wrecked as tons of short-term Bitcoin holders panic sold at a loss. Bitcoin tourists are leaving. The ARC is very bullish. I'll show you more about what that means in just a second here. So this is a thread from Glassnode. Who is realizing the most losses in Bitcoin's latest crypto crash? Between February 25th and 27th, over 2.16 billion in realized losses came from the most recent market entrants. We break down the losses by age cohorts, contrast with prior peaks, and assess market impact. Really, guys, long-term holders here, and that's what I'm always preaching, right? We want to play the long game here, not try to get rich quick here. But you can see that the largest majority of sellers in this recent past week have been the short-term Bitcoin buyers. People from 1 day, actually this is included in that same one, from 24 hours, these people buying and immediately selling, 14%, plus everybody within buying within 1 week is another 43%. So you're talking about a 57 or so percent of people selling have entered the market within the past week or a week from before they sold. In contrast, losses among those who had held Bitcoin for 3 to 6 months or longer remain negligible. If you had held for 3 to 6 months, down 0.3%. 6 to 12 months, down 0.15%. Bitcoin is a game where you have to zoom out. So as you guys can see, it's always important to look out and see where we are. You know, every time that we have a Bitcoin cycle and it goes into a bull run, the pullback seems so scary, like we're falling off a cliff. But if you just zoom out, and if you bought any time in the past, before the past couple of months, you're golden. I mean, go back in history and look at this chart. It's just absolutely insane. Coming back and looking from the beginning of time to where we are. And that's why you have to ask yourself, are you a trader or are you an investor? Not all ETF buyers are long-term holders. Only 44% of Bitcoin purchasers in the US are meant for long-term holding. The rest are likely short-term trades or speculative moves, according to 10x Research. How they came up with this data, I don't know exactly, but it's one of these research analytics firms that they pay a bunch of money to find out kind of stats like this, right? And this is where we get into the crux of the show. Who the heck is really causing this massive sell-off, and why is it happening? We have all of this fantastic news. So what is happening? Well, 44% of the buyers, mostly in the ETFs, have been long-term, are buying, hold pension funds, endowments, or ultra high net worth individuals, companies, whatever, institutions. A lot fit into this. But hedge funds, liquid funds, people who are looking to make yield on the assets they manage. Because if you're managing billions and billions of dollars and you can make 5-10% a year, that's good, right? You don't need to take too much risk. But this 56% of purchasers who helped shoot our price to all-time highs are now we're seeing the result of that trade happen in reverse. This is called the cash and carry trade for Bitcoin, where arbitrage traders buy Bitcoin spot ETF and they short Bitcoin futures. What does this mean? Well, I'm going to show you a video right now. And if it's confusing to you, don't worry. I'll explain it to you a little bit. It's quick, 1.5 minutes. Let's watch it. And then I'll explain it to you a little bit simpler so you can understand. Not to say that you're stupid, but I didn't understand a lot. So I had to go figure it out too.
At $68,000. They can sell the future on the CME exchange.
So this video was made 8 months ago, and he's talking about the opportunity that presented itself when these trades were opening up. This line right here was the spot price, and this is the futures on the CME futures price.
For delivery in December at 73,200. Now, they are now long the spot price and short the futures price. So that means that if Bitcoin rallies, they will lose money on their short position, but they will make money on their long position in the spot. If Bitcoin sells off, their short position will pay out, but overall their spot position will lose about the same. And the idea is that they can lock in the premium that exists as it stands. And this blue line that we can see here is actually the premium over time between these two. And essentially, if somebody was to sell the future, buy the spot, and hold that position till December, the spot will eventually close at whatever the price is. We may sell down to 30,000. We may rally up to 150,000. But what will happen is the spread between these two will close up on December when this contract closes, and the trader will have locked in that delta. So what this blue line is showing you is just the premium between the future and the spot. I haven't annualized this, but given that we're in July, let's just go really round numbers. Right now, it's trading at about 6.8%. So that's 6.8% yield over a 6-month period, thereabouts. So we can, in theory, double that, which means annualize. Because what they can do is when December rolls around, they can then open the next June future. And when June rolls around, they open the December future. So we can do this kind of 6-month roll or 3-month roll, whatever the time frame is. So that 6.8 will actually be double, right? So we're talking about something about 13.2% in terms of the annualized yield. Now,
basically, the way that it works is they're buying Bitcoin at spot price. Let's say it's $50, and the futures price, they're agreeing to sell to somebody in the future at $52. So guys, if that sounds confusing to you, don't worry. I'm going to show you exactly here in the next couple charts, exactly how this is working. It'll make sense, trust me. So this headline from CoinDesk yesterday says, US Bitcoin ETFs see record daily outflow of over 930 million as carry trade lose shine to the 10-year treasury. Now, keep in mind that yesterday's video, I talked about the Japanese yen carry trade, and that is still continuing to unwind and affecting global markets, but not as much as this is more relative exactly to what's happening right now. And so to explain that, the article goes and says, the weakening appetite for these ETFs could be attributed to the decline in the premium in the CME listed Bitcoin futures, which has dented the appeal of the cash and carry arbitrage. Moreover, these Bitcoin and ETH carry trades now offer barely more than a US 10-year treasury note, which carries a yield of 4.32% at press time. So now this is where it gets really interesting. So let's start paying attention to this, and I'll show it to you. But as Alex says over here, but today Bitcoin market conditions have shifted. The basis spot to futures premium has dipped 4%. This is what the guy was just talking about, 4%. With borrowing costs at 5%, the trade now bleeds 1% annually. So it's not making any money. It's no longer a profitable trade. Naturally, this results in TradFi institutions unwinding the positions. Not profitable anymore. We're not making any yield. Shut her down. It's more attractive to be in the 10-year treasury. And as you can see, these sell-offs really started accelerating on February 20th. People probably saw it coming before, or this was just fear of tariffs and everything else that are happening, leading to the decline in the Bitcoin spot price, pushing that premium down. And this is when it started accelerating dramatically right here on February 20th. I'll show you how that lines up right now. So we can see here, guys, the annualized premium was 9% annually. So an example from the guy in the video, that would have been 4.5% per 6 months, but 9% annually, which is still over 2x what you would have got from the long-term 10-year treasury bonds, which are at 4.5%. So this is still 2x. However, they dropped dramatically on February 1st, dropping all the way down to 6%, annually. And then by February 24th, no longer profitable and definitely no longer worth the risk of being in this position, being in this trade, when you can literally just go buy the 10-year risk-free rate. The US Treasury markets, US Treasury bonds are considered a risk-free rate because historically, the government has always paid back their loans. And as we can see, guys, this directly correlates exactly with the CME futures open interest. Remember, buy Bitcoin spot and short the CME futures. And you can see this really started to accelerate back here in September. What happened in September? We started to see the rally in the markets like crazy, right? And that's when they started buying, when open interest started increasing, this trade started increasing. And then now it's starting to rapidly decrease as the rates no longer become profitable. As you can see right now, the current 10-year bond yield is 4.3%. Now, the lower this gets, the more attractive that Bitcoin carry trade becomes. And remember, Trump's goal is to lower the 10-year bond yield. Now, can he do it or not? I don't know. But for now, for the meantime, it's high. And so that is attractive to people looking to manage a lot of money in the risk-free rate. You can see back here in September, the yield was quite low at just 3.5%, which made that trade really, really profitable. As we can see back here, guys, in September, when it started to take off, you were earning over 2x. And so that's still worth a trade. So September, market started to take off. This premium became really, really big, really profitable. And then it started to unwind and started to come back down. So you can see they're directly correlated exactly with each other. Now, moving on to what started the initial sell-off, and it started that premium to come back down and the prices to come back down, which started the unwinding process. And now this is why we're seeing violent moves down from slow moves down, right? And Trump announced to immediately and firmly put a 25% Trump tariff, 25% Trump tariff on European goods. And just now, just hours ago, announced that he's going to double the 10% initial tariff on China to 20%. Now, I got a lot of comments in the video yesterday about tariffs, and let me explain. I know that the revenue from tariffs is not coming from the other countries. So Trump puts a 20% tariff on China. It's not like China pays the tariffs for the goods that the US is importing into the country. Now, this is why in the video yesterday, we talked about short-term pain, hopefully long-term positive outcome, because this is going to create a major shift in the way the US has been operating. I'm going to try to do this without getting extremely political, but the difference of what's happened in previous administrations, Republican or Democrat, is what we call kicking the can down the road. So instead of making major dramatic changes, the money printer has always come on to stimulate markets. But that causes inflation. We're at a turning point right now where we can't continue just to irresponsibly forever turn on the money printer and stimulate markets. Why? Because that brings more uncertainty into the US dollar as it's debasing the purchasing power of the US dollar. The US dollar must stay strong, and we must be able to pay back our debt in order to remain solvent as a country, and if the US dollar is going to remain dominant. So these are major administration moves that are being made right now, and they're an attempt at trying something different. It's just a lot of uncertainty, right? And no one knows how this long game is going to play out exactly, right? People are pissed because the result isn't the Fed lowering rates, and it isn't the money printer going burr right now, like crazy, which could immediately fix the markets pumping, injecting money back into it. But as much as it sucks for our bags, it does seem to be a major attempt at a different way of managing the federal budget. Love Trump, hate Trump. I believe that is a fairly unbiased explanation here. And to make things worse for Trump and the stock markets and our market, the trade war is back. Now, the Kobyleski letter says, minutes after President Trump announced 25% tariffs on the EU, the S&P erased $500 billion in market cap. Meanwhile, Bitcoin just broke below 84,000 for the first time since November 11th. And as you guys can see, when he announces tariffs, people are definitely afraid of the tariffs because they're going to, in the short term, affect the end consumer in unfortunate ways. So If Nike is manufacturing shoes in China and a pair of Nike shoes costs $100, now with a 20% tariff, they're going to cost $120. And so that tariff is passed on to the end purchaser. Why is this being done? Well, it's being done in an effort to bring back a vibrant, growing economy and growing GDP within the United States. The hope is that automakers return to the US. Right now, GM, for example, is manufacturing all the cars in Mexico. Why? Because it's cheaper. So it gives cheaper cars to citizens of the United States. Good, the car is cheaper, but what about all of the revenue and all of the money being earned and all of the labor? Remember, Detroit, Michigan was the auto capital of the world. Not anymore. Remember, I remember if it was after 2008 collapse or something like that, when they were giving away houses for $1 in Detroit. You could buy a house for $1. Now, it was the ghetto, and it was a dilapidated house, but you could buy a house for $1 back after that happened, because Detroit became a ghost town, because all of it was automaking, and all of that went overseas, and it decimated the city, decimated the economy. And that's been happening to everything about all manufacturing has been going overseas. So the goal of the Trump administration, I'm not saying this is the right way to go or the wrong way to go, but I'm just telling you what their goal is to bring all that production back to the United States, saying, hey, Nike, manufacture your shoes in the United States, you don't have to pay tariffs. Hey, Samsung, if you want to produce your phones in the United States, open up a plant and you don't have to pay tariffs. Now, we'll see how this works. In theory, I actually have no idea what's going to play out, but I do believe that regardless, Bitcoin is going to be not immune, but I believe that Bitcoin is on a whole different playing field than this, and I believe it will eventually uncouple, as it is the ultimate hedge against the debasement of fiat currencies and inflation. Bitcoin is the ultimate hedge against these things. And right now, the Bitcoin fear and greed index is lower than when the FTX exchange collapsed. It's insane. That is a lot of fear out there, right? And this is what we're going to talk about here. This is the signal that we should be really paying attention to. If we look historically, mostly after times of extreme fear and fear become opportunities. Now, in 2021, we had this big run up. We had this big correction back down here. And I think the lowest it got was 15 or so. And yeah, if you would have bought an extreme fear down here at 15, yeah, it went a little bit lower. Not much though, right? It went from 29,000, from 35 to 29,000. So, but if you had bought this extreme fear here at 10. So if you could have bought 10, where it is now, went from 32,000 to 29,000, but not too long after went all the way back to 69,000 all-time highs. So historically, extreme fear shows us a pretty good time to start entering the market. Now, I'm not saying or suggesting that this is going to be a V-shaped recovery where we bounce back down here and we're at 10 and boom, all of a sudden we're going up. But I do think if you're sidelined or wondering if it's a good time to start accumulating, I think it's a good time to start accumulating, because historically, even after these ranges of fear, come great opportunities to the upside. We're about to explain that in more depth here in just a second. Tyler did it, breaks it down pretty well over here. Fear and greed is now at 20. He made this yesterday. It's now at 10 today. Out of curiosity, I looked at a snapshot of prices for majors and a few memes on the day we first entered extreme greed, November 10th, and the day we exited extreme greed. Looking at majors, Bitcoin, ETH, and Sol, if you sold on the enter, November 10th, you captured 78% of the peak. If you sold on the exit, December 18th, you captured 88% of the peak. If you're still holding, you got 63%. For the sample of memes, if you sold on November 10th, you captured 35% of the peak. If you sold on the exit, December 18th, you captured 55% of the peak. If you're still holding, you're at 23%. So selling majors, Bitcoin, Sol, ETH example, on the exit of extreme greed captured 88% of the peak upside. Very good. Selling memes on the exit captured just 55% of the move. Good, not great, but still sustainable and better than holding till now. The takeaway is it's probably good to sell majors when exiting extreme greed if you aren't holding for long term. If you're holding for long term, okay, different story. For memes, because if you're holding Bitcoin for long term, you can just hold and chill. You go through all this, you know the future is bright. You know the future is $1 million plus Bitcoin. So this moment's volatility, just spend less, chill, touch grass, a little bit like that. And I do believe personally that we're still in the middle of a bull market, but I'm not certain, and I do believe that we're going to have a bit more time coming down. And I don't know if it's going to go much lower, but I don't think that we're going to shoot back up rapidly. Could be wrong. I hope that I'm wrong, but I'm not quite sure. Continuing in this train of thought, he says, now, if you bought the Pico bottom of extreme fear back on September 6th, you had 95% ROI at peak prices on majors and even bigger gains on the memes. Now, let's remember, guys, every major Bitcoin drawdown since FTX bottom, March 23rd, so basically 22.8%, 20%, 22%, 21%, 23%, 26%, 30%, 19, 17, current 25.5. And this post says that would mean that the average Bitcoin drawdown is 22.96 with the current drop at 25.5%, slightly deeper than usual, potentially signaling we're near bounce levels if history repeats. Now remember, we've had multiple in prior cycles, 40% pullbacks, and I think that is potentially in the cards. A lot of people are calling for $70,000 returning and touching the old all-time highs. I don't know. I'm not going to pretend to have the answer for you guys. I think anyone who does is probably good at astrology. When extreme fear, and I was just joking there. I've showed this before, right? Baron Rothschild. Buy when there's blood in the streets, even if the blood is your own. When extreme fear enters the market and you feel there's blood in the streets, that is when you buy. And just to remind us to keep us, aware of what's going on, guys. Remember, things are just getting going. The new administration has only been going for 30 days, making a lot of radical decisions, throwing things out of whack, crashing our bags. But I believe it's going to take a little bit of time. The markets like certainty. Once all of these new executive orders and these things are done, I think that we start seeing the moves back up again. Plus, really important to note when we talk about this carry trade, remember, the same thing will happen again when the rates become more favorable. So if the CME futures premium starts to go back up to 10, 12%, whatever, open interest will start to come back up again, and people will again long the Bitcoin spot, short the CME future, do the exact same carry trade, and people will wondering why the markets are pumping like crazy. Then they'll realize that the 10-year treasury yield has come back down quite a bit, and the CME futures is high, that trade becomes profitable again. So Trump's goal, remember, is to lower the 10-year bond. So things to pay attention to, guys. If you're interested, let me know in the comments below. And what I could do for the next show is I can actually drop the links to these things so you guys can keep an eye for yourself so you can take advantage and just remember these things and get ahead of the market. Next time you see the opportunity to present itself where you can see that hedge funds, because they're not going to come out and tell us, right? And I'll do my best to keep an eye on this, but I can only do so much. So maybe you can keep an eye and say, oh, the 10-year treasury bond yield is dropping quite a bit. CME annualized, the premium is coming back up a lot. That trade is likely to open back up, pumping the markets, getting the hedge funds to buy billions and billions and billions of dollars of Bitcoin spot until it becomes unprofitable. Boom, another market correction. Make sense? Starting to make sense now, right? Just remember, guys, as I showed you in the fear and greed chart, in 2021, Bitcoin dropped 53% and still recovered to all-time highs. We're at a 25.5% correction right now, but a 30% is totally common. Buying when prices rise and selling when they fall is the worst investing strategy. Invest with a clear plan. And Yano overseas is confused by those not bidding here. Do you generally think the cycle is over? Do you think Trump won't do everything in his power to pump this market? Do you think pro-crypto regulations that we've waited on for several years, in fact, a decade, have zero impact? Do you think you sound smart by pontificating about macro and being bearish? do not see every major financial institution and fintech launching crypto products? Do you not believe? Remember, Larry Fink urging with urgency the SEC to create regulations where they can tokenize real world assets and pump trillions and trillions of dollars into the crypto markets. And yes, those will initially flow into tokenized stocks, bonds, commodities, but those will now be on crypto rails, easy to flow back into our precious altcoin markets and Bitcoin and pump our bags to Valhalla. And guys, remember, it's important to be able to separate the signal from the noise. And right now we have a lot of noise, but to me, the signal is clear that at least for 2025, we're going up. What happens in the next month or two? I'm not sure. If you are not in leverage positions, then you have nothing to worry about. Because if you're in tokens where you have high conviction, which we talk about a lot, like Bitcoin, like the top AI agent plays, Ethereum, Solana, XRP, these things will go back up, right? And maybe sooner than later. And some more good news, guys. Sol ETF is registered on the DTCC website. It's actually happening. Sol ETF is about to drop. It's about to pop off. Very, very exciting news. We'll see if that gets more institutional demand than Ethereum. Let me know, guys, in the comments below if you think the Sol ETF will see more inflows than Ethereum. All right, guys, that's all for now. It's been a pleasure. I'll catch you in the next one. Bye-bye.